Hi, Brian.
Hello.
Hi.
We're going to Solana today, huh?
Sorry?
We're going to a Solana project today.
Yes, that's right.
We wait. Yeah, maybe until people are joining and we're starting this, I know we can talk about the market or anything else. Is anyone exposed to a non-fungible tokens? I see here one a female punk is on my screen right now. I don't own a punk. I missed it.
I don't hold any NFTs personally.
No, yeah, I have some cats, but not the moon cats. I minted one of them, two of them. So that's the only one I got.
Oh, nice.
And I had a sock, a uni sock. I had one. I don't own it anymore.
When QuickSwap first came out, I was trying to get QuickSwap to do quick socks, but they didn't end up wanting to do it.
Pardon?
When QuickSwap first launched on Matic as like the first DEX, I was trying to make QuickSwap do like their own version of Unisocks as quick socks.
Yeah. There was also there was like a Binance sock and there was this DeFi socks. Many copied it somehow, but then it just fade away. And it's not, in fact, it's not the non-fungible token. It's more like, some kind of middle way. But the price is pretty stable now on socks. It's almost around of, it's like, it doesn't move. So if ETH is moving up and down, the price is moving. That's it. At least the sock is liquid, Yeah. So I guess we start this call. So today is the 18th November, and this is the 7th research call we have. And today we will have Brian, who presents JUICED, a project, a Solana-based project. And I think he invited the founder of it. So he will go first. And then Rodney, who presents us Maple. Looking forward to these two. And updates from the Aldin DAO side is that we have been come to a conclusion for the tokenomics over work or new tokenomics. In fact, it's like a new product basically. And but the rule of the Boule, the task of the Boule is like unchanged. And what we like to do is we send it to almost all of the contributors the forum link where there's a write-up which direction we go. And then there's also like quite a good I just posted on the Discord on the closed contributors channel, and there's quite a good explanation. Or yesterday, Kruger, one of the core contributors, he did present it in the contributors call, so you can also listen to him explaining how the new tokenomics is working. And the idea is that now we do the research call, and then I ask people who have more time to spend to stay, and then maybe we can discuss this further. The thing is, it's, in my opinion, it's an important step forward for Aladdin DAO, and we try to collect the most possible feedback from diverse people. But we as a core as a Boule members, we have a lot of experience looking at products and think about if this could be a usable product and all this kind of thinking. And so I guess it would be very good to have feedback first from you, and then we will publish it more in the open, get feedback from the community. And yeah, so this is as an intro. So I give the stage to Brian Lee, who presents JUICED. And I would ask you maybe as an intro also say what's your connection to this project. So just to be transparent, if you're an investor or how relate to this project.
Yeah.
Yes, please go ahead.
Hi, sorry, can you guys see me?
See
Or-
not, but hear you.
Wait, okay. I'm not sure why my camera doesn't work. But yeah, anyway. Yeah, so I'm Alameda. So today I'd like to introduce a project called JUICED, which is a automated basis yield farm based on Solana. So something that we're seeing is you know, Solana, the Solana ecosystem has matured, has become more matured, and then the more primitive DeFi instrument has been established. You know, like the basic like margin bar lending, perps, you know, AMM. These are all available. So there's more interesting ways for projects for user to get yield. And I think it's like super interesting to sort of find yields that's not a food farm yield, but rather more sustainable and automated. So I invited Shadow, who also ex Alameda. He's the founder of JUICED to present. So I'll pass it to Shadow. Sorry, one more thing. We for disclosure, we are investors in JUICED. Yeah.
Yes, thanks.
Hey Brian, thank you for the introduction. If I have some slides, should I screen share those, or should I just talk about the project?
Share would be nice, I guess.
Okay, let's try and figure this out. I might have to be made a presenter.
Yeah, the thing is, I don't exactly, but yeah, I don't know if I don't have this right. So Charlene, maybe I think you have to.
Yeah, I think
on your side.
Yeah,
It's a setting on your side.
correct. Anyone can project a slide.
Maybe you have to leave and rejoin. I think there's a setting in the setting of Zoom, I guess. Yeah, he rejoins. But Brian, just shortly, so yeah, I want to a little bit ask, so what's your investment thesis with this project? Because we're looking for projects who are long-term successful, and somehow, yeah, you pick this one, and maybe you can add some words during the
Yeah, I
JUICED
mean,
guys figuring out.
yield farming, it's like a big part of our strategy. So you know, anything, you know, we're seeing like, you know, DeFi 3.0. I'm not sure what that means now. Like people say DeFi 3.0, 2.0, but like, you know, we're seeing yields that are more interesting, like that's more sustainable. We're seeing like structured products, things like that. So, you know, these are all things that we could potentially deploy into. So, you know, investing in them seems a natural fit. Yeah.
Okay. Okay, Spec.
Yeah.
Hi.
Hello?
Yeah, hi.
Let's
We hear you. We see you.
Let's try this. See if we can. I feel like this is something that I've done before and other people have done, so I feel like it shouldn't actually be difficult. No?
Yeah, it's a setting somewhere in the Zoom. Sometimes it's not very well defined. Yeah. You're not the first one who struggles with this.
Could it be something to do with... Oh, let me install the Zoom client. I'm using my browser.
Maybe that's, or is it public, the shares? Are they public? You could also share like a link, and
Oh,
then
yeah. I'll
somebody
put a
else
link in
can
the
share
chat.
then you can just, I can do it. You just tell me if I show you the next slide.
Yeah. Okay. Actually, I'm gonna exit and rejoin real quick, and then see if that doesn't work. We'll just do that.
Yeah, DeFi too is somehow a shift. Everyone understands something different under this term, I guess. But one of the things we see that people or projects, they stop like spending like just simple liquidity mining. It's somehow it's over. It looks like
Are you guys able to hear me now?
Yes.
Yep.
Okay. Now I think I can share the screen. Let's look for this one. Sorry, permissions. Sorry, I will have to quit and rejoin again to
Yes.
Zoom.
You're welcome.
Permissions.
Yeah.
So like this project is a little bit different to I'm not sure who presented last time. It's called Lima Finance. So it's a similar strategy in Solana, but it has like a baseline yield. So even though if there's no basis trades, basis yield, like there would be like a baseline yield from yield farming. We'll explain it later.
Somebody asked what's if there's like a project token page for JUICED.
Yes, I can share that in the
chat, yeah, maybe. Oh yeah, we see it. No, it's on the screen. Now we see you.
Oh, cool. Let me yep, I can post this link in the chat.
Yeah, I can do it. Thanks.
Yep.
Cool.
Okay, let's cool. Can you guys all see these slides?
Yes.
Okay, perfect. So sorry for the delays there. But we're here now, and thank you, Brian, for the introduction. One thing I want to clarify before we start, I was hearing the end of talking about Lima. Is that correct? And it sounded like I heard it was doing something similar about offering a baseline yield.
Yeah.
Yes.
Okay.
Yeah.
That basically say that you have something in a yield firm somewhere, and that will give you a baseline of X% no matter what, in addition to what the derivatives are doing.
Yep. So I was talking about Juice.
Okay.
Yeah. So that's yeah.
Oh, okay. So, yep. So yeah, basically, sort of at the high level, as Brian said, Juice is it's a yield farm actually in name only. Juice itself is not an AMM that is yielding out for putting money in there. But it will look a lot like one. So the fundamental thesis of Juice is that perpetuals, which are basically a derivative, that pays out some amount of funding regularly, basically like the crypto derivative, both centralized and decentralized. They are usually paying money to shorts, which basically means that people are paying the shorts of the derivative money because they want leverage to go long. And what this means as a trader is you can think of a trade where you say, oh, well, what if I buy one Bitcoin and I sell a Bitcoin perpetual? I'm not taking any, if Bitcoin goes up or down, one side of that trade makes the same amount that the other side loses, and I collect that money or the funding payments. And this trade is actually one of like the major cornerstones of, basically, I would say most like market makers in crypto. And analogous versions of this trade are sort of a cornerstone of many market makers in traditional finance. And JUICED is basically sort of trying to make like the same sort of trade easily accessible to like anyone to put USD in. There we go. So there's a high-level overview of what JUICED is doing, and sort of one sense is that we are building managed derivative and farming products on chain, largely using Serum and other products on Solana. And the sort of three cornerstones of JUICED are three things. One is rates arbitrage, and that's basically a fancy word for what I just described, is that some variant of, you see perpetuals are paying shorts money. So you go long, a SOL, short a SOL perp. You don't take risk on the price of SOL, and you collect that. And more generally, it can mean doing something similar with borrow lending protocols, integrating yield farms. Basically, finding some combination of positions where at least one side of the position is paying you money, and the other sides are either not costing you anything or they cost a lot less than the sides that pay, while hedging out your price risk on the actual products that you hold. So the next thing in line is what I would call portfolio optimization. And the idea behind this is that basically like the best thing to do with your money at any one point in time is changing. The really simple example is if like one day, maybe it's like Bitcoin perpetuals are paying, 40% a year to shorts. But for some reason or other, as a month goes on, Bitcoin goes down to paying 10% and SOL goes to paying 50%. And so the thing that you want to do is sort of start reallocating your capital from the Bitcoin trade to the SOL trade, because you're simply getting a lot more out of the SOL trade. And it's not meaningfully changing the underlying risk you're taking, because you're basically in a pure interest rate position. And again, you can extend this to just sort of like with rates arbitrage, generally finding the best combination of positions across products in the Solana ecosystem to both maintain delta neutral and also collect payments of a sort. And finally, the project will hopefully be actively engaging in providing liquidity on the various order book venues. I'll sort of go into and the high level reason for that is you can get significantly better execution that way than if you are simply sending like limit orders and eating the spread, as well as like a 10 basis point trading fee. And due to the nature of these projects, the protocol will need to actively trade as things move. Just going a bit more into the specifics of what these mean is sort of like, as I said, with rates arbitrage, you find some basket of products that are delta neutral and get you the most for your money. So like this neat little diagram over here, some idea behind it is maybe, you go short a Bitcoin perpetual on Mango, you buy your Bitcoin spot on Mango, so you have a hedged position. But you don't actually have to put all of your Bitcoin spot on Mango to margin your derivative. You only might have to put like half or a third of your Bitcoin there to be safe. So what you do is you can say, take the other 2/3 of your Bitcoin and stick that in, Saber, or whatever the best place to put that Bitcoin is at the time. So instead of sitting on Mango as collateral that's not needed, this 2/3 of a Bitcoin is actually being productive somewhere else. portfolio optimization, like if you look in this example, it could be that 1 month, Sabre is paying you 20% a year. The next month, it costs 20% a year to borrow a Mango on Mango. Or sorry, borrow a Bitcoin on Mango. So what you actually want to do is just, you might as well just leave your Bitcoin on Mango being lent out. And the liquidity provision is sort of one thing that you might have guessed is as you're moving all these positions around, like you have to engage in trading. You also actually have to engage in active trading for margin management. Is even though you are delta neutral, you will, as prices move, you'll either start taking more leverage or you will start taking a lot less leverage and have capital that's not being very useful. So the JUICE protocol will have to be actively trading as the markets move. And providing liquidity is a very good way to lower execution costs because, at least on one side of your order, you can not, instead of, crossing a spread, which are still fairly wide and paying fees, you will earn the spread and the trading fees. At the moment, volume on the Solana exchanges isn't extremely toxic, which means that if someone trades against you, it might not be like jump trading, realizing that you have a bad order out and taking your lunch money. It's just that someone legitimately wants to trade and you're providing liquidity. But there are some pretty basic strategies that sort of obviate risk that you only get filled on one leg of your trade. One being that you have some software that is you're either cranking this at a high enough frequency so you always see when you get filled and go hedge. Or you can actively look for when your order is going to get filled and make sure that you are sending enough cranks to the protocol to make sure that it hedges quickly. And this is a very good and straightforward way to save costs. If we want to actually go through a worked example that is probably still real right now, is that sometime this afternoon, the perpetual on Mango is paying 50% to shorts. It was cost maybe 10% a year to borrow a USD on Mango. And I looked at a few of the stablecoin farms and they were paying about 20%. And right now on Mango, you can, with this, enter a position that does not take risk on the price of Bitcoin. So Bitcoin goes up, Bitcoin goes down, you don't particularly care. So very similar to a stablecoin farm, but it pays much more than 20% a year. The first iteration of this is sort of a trade, the cash and carry trade, which I've talked about more than one time already here. So sorry to keep repeating myself, but again, very, very straightforward. You short a Bitcoin perpetual, buy a Bitcoin spot, and you hold that position. And the moment in time funding is going to be paying you 50% a year. So that's already quite good. And if you are willing to take more risk, one thing you can do is leverage this. So you might say, okay, I have 1 Bitcoin of collateral and I'm short 1 Bitcoin perp. So my position size is, I have a leverage of 1. So you can then borrow 1 Bitcoin's worth of USD to buy another Bitcoin, and you short 1 more perpetual. So now you have 1 Bitcoin, you've borrowed USD to buy another, and you've shorted 2 perps. So you've taken some amount of leverage. You're 3x leverage now, in that you have liabilities that are 3 times the amount of capital. However, you're still in a market neutral position. And since Mango, in this case, is cross-margined, your position is fairly stable. If the price of Bitcoin goes down, you immediately realize a lot of USD from your derivatives or from your perpetuals, and that's fine. You've made a lot of USD. So you're actually becoming less leveraged if Bitcoin goes down. And if Bitcoin goes up, you will start taking more leverage as you realize a USD loss and go negative USD from the derivatives, but your 2 Bitcoin are equally growing in value as collateral. So it's not completely risk-free, as eventually you'll take so much leverage that the exchange would liquidate you. But this is one reason why Juice is actively trading. The prices have to move huge amounts for you to take too much leverage in this case. And it's very large because of the offsetting position. It's not like a normal like 3x long position where if the price moves 30% against you, you get wrecked. So it's still fairly safe. It takes some more risk, but now you're looking at a 90% yield. You're getting 50% times 2 from your Bitcoins, and you're paying 10% to borrow. And one of the things we plan to do is offer, products that sit along various points in this risk reward spectrum. One is, you can say, have a class of products that take absolutely no leverage. Again, short Bitcoin perp, buy a Bitcoin, leave all of your Bitcoin on the exchange. And that can be a whole class of product for someone who's very risk averse. Or is like really worried that the perpetual funding will start paying a lot to longs more quickly than the protocol can enter that position. All the way to trades like this one where you borrow USD to enter a more leveraged cash and carry position, where you're still market neutral, but there is some degree of higher risk taken in that and the protocol will have to trade more aggressively to make sure that you stay that your position doesn't get too large.
Okay.
Apologies.
Thank you. Yeah, this is very helpful to see very detailed how this stuff works. Because
yeah. Actually, I'll talk about another example I didn't write down that's very similar. I think I briefly mentioned where you do the same trade as number one, short BTC perp, buy a Bitcoin. But instead of taking more leverage on your Bitcoin, you can send that Bitcoin off to somewhere else. So as far as Mango sees, you're short one Bitcoin and you are long 1/3 of a Bitcoin. So you're pretty leveraged. But the rest of your Bitcoin is actually off, like being lent out or in a yield farm, or like who knows what it's doing. All that really matters is that you have 2/3 of a Bitcoin long position doing something productive. And this is where Solana is really amazing, which is that you can send your Bitcoin straight back into Mango on a moment's notice. I've worked in crypto quant trading and like personally witnessed, situations where someone has a trade like this. You're short a derivative somewhere. Actually, usually it's that you're long a derivative somewhere. A big liquidation spree happens and the market starts going down 10-20% in 1 minute. And all your collateral is at a different exchange than your derivative. And you hit send, and all you really do is like helplessly watch as your position gets liquidated, and then 2 minutes later, a giant amount of collateral lands at the exchange.
yes.
That's just not, that's a drastically lower risk on Solana if your time scale moves from like 10 minutes, 5 minutes to 5 seconds, 10 seconds worst case. Like it's very heard of for like coins to drop 50% in 10 minutes. Not common, but like if it happens once a year, it's gonna happen to Juiced. Coins tend not to drop 50% in 10 seconds. And I think in cases where they do drop 50% in 10 seconds, you were not getting out of that happy no matter what.
But are you sure? I would assume if a system is just faster, then also these kind of reactions will be faster of the whole system, basically.
Yeah, I guess the only case where I think that would happen if there's a complete rug pull.
Yeah, of course.
In theory, if there's a complete rug pull, okay, if there's a complete rug pull, your short position is fine.
Yeah.
The risk from liquidation comes when like you get liquidated at 30%, the market moves down 50%, and then it goes back up to 20% down. That's when you actually come out of it very bad. So if things go straight to zero, then like one side of your trade is making 100%. But
So
it's obviously a very bad
which
situation.
state are you? Are you like, is the product ready, or are you still in the development?
Yeah, we are still in the development stage. So actually, so I'll elaborate a little bit more on that. There is a more or less working version of the product. One is that we are still just like doing a lot of like validation and testing work of the product. Obviously, in DeFi, you have a lot less escape hatches if there's a bug. The reasons for that. We're also working on monitoring and alerting software, just so that like we don't we don't want to wake up to a surprise or wake up to like something bad where like maybe there was something we could have done. The other reason is that Mango is not particularly liquid. None really of the on-chain derivatives exchanges, I think, or fully decentralized like on-chain derivatives exchanges are particularly liquid, and that actually poses a problem for JUICED because derivatives are not fungible between, say, like Mango and FTX. So if you're on Serum, like you can trade as much spot as you want on Serum. I will, as a market maker, sit on the other side of your trade and trade spot like 5 basis points good to FTX all day long because I can just send spot back and forth and it's a true arbitrage. But you can't do that with derivatives. They're sort of stuck in Mango.
Okay.
And if JUICED is, say, trading in only one direction for size on Mango, if you're doing it on a book like even Solana, which I think their biggest book had $10 million of volume today. So if you release this and then like people are putting in $10 million a day of volume, you have sort of one directional long-term position holding volume going in Mango in one direction. And that can really aggressively hurt yields there. I also have a suspicion that a lot of the liquidity being shown on Mango is only there because people are getting Mango rewards. And the instant they start getting filled for any amount of size, it's all going to go away.
Yes.
So we're also working with some people to help them get set up to actually be providing real liquidity on Mango with some amount of size and like a knowledge that they're actually going to trade and not just get Mango rewards. And that,
okay.
So we expect that we will be able to release the product sort of like late December. It's a pretty conservative estimate, but I feel like it's always better to be like a few weeks more conservative than make too many promises. And it's better to release these things when they're ready rather than like rush something out the door.
Yeah, I don't know. We try to keep the presentations around 20 minutes or so. So do you have a lot to add or?
This was largely the meat of it. Let's see, there's
some question in the chat. Maybe you can.
Oh yeah,
I can read them or you.
Oh, I didn't even see this. Okay,
yeah, that's okay.
Yeah, here's a question. Once drift trade is open to all, are you planning on also integrating? The answer to that is yes. Like our view is that in general, we want to be anywhere where you can get yield of some sort. Whether like drift would be the first thing we integrate when it opens, it's that's unsure. It depends on the contract specifications, how the protocol works, how much liquidity is there. One sort of, I think, underappreciated things about perpetuals is that it's sort of subtle to price them properly if you're comparing one perpetual to another. So even if a long-term two perpetuals are paying 20% a year, if at a point in time, if they have different funding cycles, you might actually be losing like 6, 7, 10 basis points a trade if you're just very naive about entering them and you enter them at like poorly priced times. So the only real catch here is we'd probably want to be careful about like if the contract works differently, making sure there's some logic to make sure that we're not doing like bad arbs or arbitrage, as someone used to tell me. But like other than that, yeah, if there's a derivatives venue, if there's a yield farm, a lending protocol, it is on our radar for something we would want to integrate with.
Can you talk a little bit? So are you going to have a like governance token, and what's the relationship of these like yield generating positions to that token, or are these just going to be vaults that would then return profits in, say, Solana or Bitcoin?
Yeah, so unfortunately, the advice I have gotten from legal counsel is if the token is an avenue to return products, we both have a security and I am also at risk of going to jail. So we don't have immediate plans to give profits back to the token holders directly via the token. What we do, however, plan is that token holders will get significantly reduced fees on the protocol. As for governance, so there are a few ways this will it can play out. One is that like it's going to be there's going to be some questions about like what new protocols do we add? Like do we go for like if there's 20 different protocols, we can't just like add 20 different protocols in a week. So there's some questions of like what do people actually want to be integrated with? There's going to be a lot of questions about what products do we trade? Because there's going to be like some risk reward balance of like, do we want to integrate with this like really new coin on a really new yield farm that's giving like 20,000% APY? Like seems great, but like you also might get completely rugged. So those are questions that would probably be like opening up to governance. Yeah, I see. The next question is, why would I use JUICED over UXD? UXD seems to do the same, but I would also get a stable coin. Yep. So I have two thoughts on this. Brian sort of answered one, which is that, as far as I know, UXD is not being as aggressive about finding sources of like rates and yield. The other thing is that we thought about offering a stable coin. But as someone, as Tom mentioned in the chat, like stable coins come with a lot of, I'd say, bank run risk. Like if something happens and a juiced vault loses 5%, that's really unfortunate, but it's not an existential crisis for JUICED. Like it's advertised as a product that carries risk of some sort, and it should be low risk, but like it's a risky financial product. If I tell people that a JUICED token is equivalent to 1 USD, but you get yield, and I make all these promises that it's going to be a stable coin, and then I lose 5%. Now there's probably going to be a bank run because you're clearly not stable. So I sort of view stablecoin as like, this almost fits the bill, but I think that it's adding a lot of risk that you go down just a little bit, rates move a lot and the funding goes bad and things start to drop a bit. And suddenly people are looking at something that has lost its peg.
Yeah, I did just see a DPEG event last week on Curve, and yeah, it's a lot of risk. And the thing is, if people see this risk, they won't use it as a stable. Basically, they only use it to get access to other farms to farm it, but there's little chance that you get really into the system, be used as a stable.
Yeah,
That's what I see.
It. Yeah, I see it as like even with the lowest risk trades, it's sort of risky because I do not believe this is a risk-free trade. I think it's a low risk, but I would strongly assert it's not risk-free.
Yeah.
And it
But
would
it's a
also,
good story to tell, the story
Yeah,
itself, it's of course.
it's a good story. You're delta neutral. Where could there
Yeah.
be risk? Premiums will always pay to shorts, which is true until it's not. But also, I think it would really prevent us from going after opportunities that bring on more risk and bring out significantly outsized return. Sort of like there was an example I brought up where you leverage and you're still delta neutral and you take some more risk, but you just doubled your yield. And we're also considering down the line adding trades that aren't completely delta neutral. So
okay, I think
yeah.
the time is running up a little bit. Sorry to interrupt you.
Oh,
We have
no
like
worries.
a second presentation. So I know if they're like last question, maybe we can have them now, or we have to move on. I'm sorry. Yes,
Yep.
Ivadet, do you want to ask anything?
So I think the core of this question, are we capable of implementing a non-EVM, non-Ethereum yield strat at the moment? I think the answer is yes, because this is a non-Ethereum EVM yield strat, if I understand it. I mean, it's happening in my personal
But
account.
the question is more to us as a entity. Alindao is heavily focused on EVM. Oh yeah,
Okay.
because in fact it's not. We are technically agnostic because it's not. You have a product, but the Boule itself, it's like the main thing in this project. But we can right now we cannot. But maybe we can over time we can go to other chains too. It's just a matter of resources.
Yep, definitely.
Yeah. So thank you very much for your presentation. Yeah, I did get better what you are doing or what these kind of trades, how they work, and thank you very much.
Hey, thank you guys for listening to me ramble for 40 minutes.
Yeah, cool. Thank you.
Hey.
So Rodney will present Maple as next, and yeah, thank you very much.
Sweet.
There we go.
Let me just see if I can share my screen. Can you guys see this?
Yes. Yeah, we see it. Thanks.
Sweet.
Yeah, maybe you can also just short if you have any connection to this project or if it's just out of curiosity or.
Yeah, for sure. Yeah, we do have some exposure to Maple Finance as a fund. And also, I met Sid in Lisbon, actually. We ended up overlapping at tons of different events. So I ended up getting closer to the team. But as a fund, we also have exposure in like TrueFi and also in Goldfinch as well. And these three are kind of like the main protocols that are debt protocols going for under collateralized lending. So I don't think we have like a particular bias to any one of these right now. Just because we have like exposure indexing all three of them, but I can go into this one specifically because I think it's pretty cool.
Okay, thanks.
Yeah. So yeah, as I mentioned, within crypto capital markets, this is under collateralized loans for institutions, primarily. And I don't know how familiar you guys are with Maple Finance, but basically the way you'd use it is you can browse the lending pools on Maple, choose a lending pool based on its performance. You can deposit USDC so that it'll be lent out by like pool delegators, and then you would be earning interest rate rewards plus governance token rewards. And the lending pool funds loans to top crypto institutions that are all KYC'd as well. So that was like a quick summary, but I'll go into every one of these components and then eventually my recommendation for what we should do as Aladdin as well.
Yes.
So for the first part, there's lenders. So the lenders are people who want to lend out their USDC. So they earn a yield from a diversified pool of institutional loans. In summary, here's for example how the different pools look. So you can see that within these pools there's a pool balance, a cash balance, And you can see that there are pool delegates managing these as well. There's like an APY associated with them. But basically, this is the interface that you would look at if you're looking to lend on Maple Finance. So the way the lending APYs work is you would deposit USDC into the lending pool, and you'd get MPT tokens, which are the pool tokens for the lending pool. And then you can also deposit those MPT tokens to earn additional Maple rewards as well. So it's like 2 layers of yield there strung out, which I'll separate in a future slide, which makes up the high APYs that Maple has today. Here are some of the different lenders on the platform right now. You guys would probably recognize a lot of these names. And it's not just, funds that are lenders on the platform. There's also just regular, democratized lenders, regular users, in addition to these players. But these players are known to be farming on the platform today. So when these lenders lend money, they're not lending it directly to institutions themselves. They have to go through this party called a pool delegate. And the pool delegate earns yield from a diversified pool of institutional loans by crowdsourcing the capital to lend out. So you can think of it, if you're familiar with like the AngelList model, these are like the syndicate leads. They like bring the lending deal flow, they do the underwriting on their end, and in exchange, they have people that are willing to lend them money in order for them to lend out, kind of like Goldfinch's model, but they earn essentially carry on their successful loaning. So yeah, they, in summary, they manage lending pools, attracting capital, and then they provide funding to borrowers. In addition, they're responsible for like negotiating on loan terms, doing the diligence. So for example, in TrueFi's case, they don't have a delegated system right now. TrueFi does themselves like all of the underwriting, but within Goldfinch's case, they have a similar model where there are delegates that are the intermediaries that take on the burden of negotiating terms with borrowers and doing all the diligence, which is like a more scalable model in the long run, where the people are incentivized to be like diligent, like pool delegates. Otherwise, they would have no upside from managing this money. So yeah, I just wanted to circle where you could see like who's the delegate for any given loan. You could also see it at the bottom, who specifically is the delegate, but every single pool is tied to a delegate right now on the platform. And here are the 3 delegates that they have right now. I think they actually just announced that Alameda launched their pool too today. So you could slap Alameda's logo alongside these guys as well. Yeah, and then the last part of the equation, apart from the lenders and the pool delegates, is the borrowers themselves. So these are, institutional borrowers that are borrowing fully on chain, and they're fully KYC'd as well. So the borrowers can use their reputation to borrow under collateralized loans without fear of like liquidation or margin calls. And the reason why they're doing it like primarily to like institutional and corporate borrowers today is because it's pretty hard to do under collateralized lending. I mean, for the most part, everything we've seen in crypto is over collateralized lending, which is like, capital inefficient, because within the real world, everything is basically under collateralized lending. But it's kind of hard to translate to crypto because you'd be like prone to Sybil attacks if you just did it like fully anonymously, or like, people wouldn't like repay those loans. But if you do like the whole KYC process today, it's like, the V1 of under collateralized lending. In the future, there might be like, reputation protocols or other like ways to understand the credit score of a protocol, or like, DAO income streaming to loan repayments, which could like also de-risk loans and like potentially allow for under collateralized lending to exist more so. Also, like more primitives would probably have to be built out, like credit default swaps and other things that have been conceptualized in the past but haven't really had a place to have a product market fit. But once under collateralized lending is more accessible outside of the world of institutional borrowers, I think a lot of the infrastructure there would have to be built out, mirroring what's built out in traditional capital markets. But yeah, right now the borrowers are just like hedge funds, prop traders, market makers, exchanges, centralized lenders, crypto miners, and scale ups. It's pretty hard for like, a hedge fund to go to their bank and tell them that they want to borrow a bunch of money to throw it in a risk neutral strategy today. But these sorts of like on-chain lenders have been built around this sort of value prop to begin with. So they're fully equipped and ready to provide these sorts of loans. Yeah, and then here are the existing borrowers today. So you have Wintermute, one of the biggest market makers, Alameda, Amber, which is like one of the biggest like OTC desks as well today, and a bunch of other players too. And as for the strategy that I recommend for Aladdin, we can lend money to experienced pool delegates in exchange for interest payments and Maple governance tokens, averaging between 25 to 28% APY from the existing pools that they have on the website. Here's just like an example of how quickly like Maple has grown. It launched in May with like around 17 million of loans initially on the platform. But since like October and November, it's been growing at like a pretty rapid pace. Like in October, it like hit 200 million, November it hit 300 million. And it's been making some pretty crazy announcements. I think this morning with Alameda, it launched like a $25 million pool as well, and which would bring the TVL probably around like 340 million now, but I'd have to go check. They have been growing at like a pretty impressive pace though. So the APYs here, yeah, they're like broken out into the investment APY from the interest rates paid by borrowers and Maple governance token rewards. And the reason why this is interesting is because the APY in governance token rewards is like calculated at like today's Maple market cap. But if the price of Maple tokens went up in the future, then the effective APY realized would have been a lot higher than the APY quoted here. So if you believe that like under collateralized lending would increase as an asset class in terms of market size, and you were to take this sort of position, then if like Maple 5x's in the future, you know, theoretically, then like the Maple yield portion of this would have been closer to 95%, and in addition to the 9% interest, whenever you do cash out the loan, depending on if the protocol price goes up. That's kind of the benefit of like mining tokens that are, you know, in your like thesis, undervalued governance tokens. Because if you're right about them being undervalued today and they end up increasing in value tomorrow, and you're farming them with like relatively neutral strategies, then you'd be having a lot more upside in the future if you're right. So yeah, comparing him to TrueFi, which is I guess the biggest player within under collateralized lending, you can see that Maple has roughly 1/3 of the loans of TrueFi, a bit less than 1/3 of the market cap, a very similar fully diluted value to TVL ratio. It kind of looks like that the market is valuing TVL similarly across all of these sorts of players today. So you can expect that if the TVL of Maple were to go up and the ratio would be still similar to TrueFi, then the fully diluted value would go up proportionally as well, which is pretty beneficial to our, you know, thesis of the lending APY could potentially be higher if governance tokens are appreciated in the future. And yeah, as I mentioned, also the main difference between Maple and TrueFi's underwriting and scaling model is that Maple has these pool delegates that are incentivized to have successful pools and raise their own capital and source their own deal flow, whereas TrueFi does all of the underwriting in-house. That's like today, you know, TrueFi might change their model in the near future, but Maple has been using this model to date. In addition to Goldfinch, I know I didn't put Goldfinch here. Goldfinch has around $40 million in loans originated. They don't have a token out yet, but they also have like pretty high APYs, though their pools are always like pretty full. Maple though has like seemingly more openness for capital to flow into it, and I think it has a lot of potential upside in the future. So yeah, in summary, like the pros and cons of like Maple is, you know, the pros are the TVL is growing really quickly because of the scalable underwriting model, and pool delegates are like a great scalability model to not having to insource underwriting and negotiations of deals. It's also more decentralized in that way in comparison to like TrueFi. The category is growing a lot. I think that, you know, under collateralized lending within the real world is like a significant portion of all of the flow within the finance world. Whereas right now, if you were to add up the enterprise value of every single party operating in under collateralized loans, it's probably like 3 to 4 billion in size relative to like the $3 trillion market cap of crypto today. So definitely hasn't found any real category market fit because a lot of infrastructure still has to be built out. But in general, I do expect for the tailwinds to push these projects forward, moving forward. It's also not like, you know, traditional like stablecoin depegging risk that you'd be taking on, but instead it's more of a lending risk. And the lending risk, it is a real risk, but the pool delegate system incentivizes people to make smart decisions. Otherwise, they wouldn't make money with their delegate pools. So in a way, you're kind of, trusting that the pool delegates are lending their money, with the idea of making money on top of it, instead of just like giving it out without doing proper diligence on the commitments that they'd be making. But with that risk aside, the APYs look pretty good. And the cons, I mean, I know that the token design for Maple hasn't really changed since launch, and they're considering making some changes, but there isn't too much you could do with the token right now. Theoretically, there could be like a governance proposal tomorrow that, would like offer Maple holders like the fees that are earned on the platform. Right now, the main way of using the Maple token is if you're like setting up your own pool as a delegate, you'd have to stake a certain amount of Maple tokens. And there's also ways to like make some staking rewards on Maple tokens, but they'd have to like definitely flesh out that model better, similar to Aladdin DAO, in order to make it a lot more lucrative for the users. And also one of the bigger cons is that borrowers are not really brand loyal when it comes to like borrowing from under collateralized lending players. They kind of just care about the rates and terms of the deal. So it is kind of a race to get to, the ideal like economies of scale / like rehypothecation of scale that would allow for, shorter term, relatively more under collateralized loans to be given out to parties, which would be better terms for borrowers in the future. So yeah, that's my presentation on Maple, and open to any questions.
Thank you.
I love it, Rodney. I've known the team for about 3 months. I've spent a lot of time looking at Maple and thinking through how it's designed, and I appreciate the cons you called out, or the downsides, but this just checks off all the boxes for me. It's easy. You're lending stable coins. You're working with a reputable protocol that's audited and doesn't have, I think, as much like surface area in the protocol for attack. Like it's pretty straightforward the way the smart contracts work. And yeah, I think the one thing that's concerned me is there's been, if anyone goes to maple.finance, if you open up the app, click on any one of the loans, and you can see the terms of all the different loans that have been opened, which is, I think, a really cool demonstration of how DeFi is better than TradFi. But the one thing there that I've heard criticism about is just only one of the loans, I think, has matured. Most of them are about 180 days old. So we're about to see a bunch of them mature. I would be doubtful that these very reputable borrowers would, not pay back. But there definitely was, just a lot of talk about, what, I mean, are these folks going to pay it back, or are they just going to open up another loan here and continue to sort of take advantage of like the best terms with no sort of brand loyalty, like you mentioned? But I do not think that that's, I don't think that risk outweighs the rewards here, especially for a farm that you can accumulate a token right now with Maple, where they have a fully diluted valuation of about 250 million. And their circulating market cap is about 66 million. So I love the idea of being able to earn that aggregate yield that is juiced by a token that is, I think, pretty arguably undervalued based on what you said. And I have no exposure to Maple, so I say all of that, I think, with no sort of bag bias.
Yeah, I see here they have like majored some around 10 or 20, no, 10 maybe majored.
Yeah, I was going to
loans
say,
there.
I'm a very tiny personal LP in one of the pools, and so far $0 the pool that I'm participating in have defaulted, and I think they've had like 5 or 6 loans in that pool mature. So it's a good, 100% hit rate so far, just as one more data point.
I just think this is more prone if you have really a market downturn and it's like an extended one, then yeah, but then the whole industry is in trouble anyway. But this is the only risk I see, because these companies, they're part of this market, and if they leverage too much on a bullish strategy, they maybe will have trouble themselves to pay back. But That's the only
Yeah.
risk I see.
If the pool delegates are like experienced in like, you know, just like lending and underwriting loans in general, hopefully they're able to plan for like, you know, market volatility when they're like giving out these loans. I haven't talked to any of the underwriters themselves to, you know, see what kind of like diligence or strategy they have in mind for those sorts of things. But in an ideal world, because all of these parties that are originating these loans are, you know, experienced, well networked, and have been doing this for some time, it offsets that risk for the lenders.
And also, Rodney, to your point, just one comment on like for market makers and certain trading firms, they just benefit more from market volatility. So kind of it depends on the makeup
Yes,
of those
true.
that borrower pool, but they can actually, you know, benefit in the downturns as well, of course.
Yeah, yep, that's right.
Yeah, the pool delegates, as far as I've understood, and I believe Daniel, who's one of the co-founders, is one of them. I think they've all got really credible track records. So yeah, there is a little bit of uneasiness, I think. Like when you think about there's a lot of blind trust probably going on within the community that the pool delegates, you know, are most capable of making that evaluation. But yeah, I mean, this looks so much less risky than I think so many other things that many of us would be willing to participate in DeFi. And I put myself in the middle of the spectrum. I'm definitely less risk on than the most degenerate in our space. So I think this really does fit the mold of what we're looking for with Aladdin DAO. So great presentation, Rodney.
Thanks. And yeah, to your point, it is a different kind of risk. So I definitely think that within a greater like yield farming portfolio, if you don't want to like have like, you know, the central point of failure for your yield farming portfolio be stablecoin risk of some sort, then it'd be good to diversify the types of risk that you're taking on like in an underlying way, you know, across like lending risk through this model, across like, you know, stablecoin A risk, stablecoin B risk, maybe some insured stablecoin exposure as well. But I definitely think it has like a place within like a given portfolio for sure.
Yeah, thanks. I think if there are no question, we will end our like official part of the research call and maybe go to the more unofficial call. So if you have more time to spend with us, so I ask you to stay. And the thing is that, yeah, maybe I ask Charlene to recap because we changed a lot in the new product, and some of you maybe did read how we're going to change it, and maybe Charlene can better explain in which direction we're going to change, because sometimes I have the feeling my English is not that good enough for this complex stuff. And yeah, I don't know, or maybe we can just start discussing, but I assume not everyone did like look at the forum entry, and but it's a big shift. You know, we try to change the product, and I guess one of the cornerstone of this that we take 100% of the fee, and so we keep the money which is we get, and we will manage this in a certain way. But maybe Charlene can take it from here.
Yeah. So one of our contributors, Kruger, sent a proposal on the forum yesterday. I just post that link in the chat. So in case people haven't really looked through this, so at very high level, so Aladdin is going to turn ourselves into a protocol control model, and going to manage the treasury and by the strategies recommended by the Boule. So basically, Aladdin Treasury will be a good reflection of the Boule's capabilities. So we're going to take on asset in a couple of ways. So people can actually bond assets with us with native assets directly, like Bitcoin, Ethereum, and stables. And this is more for, you know, like risky users who want to just get Aladdin tokens at discount. So the way how it works is they give us, you know, these native assets, and we can give, them, or sell them a bond, and we give them tokens with a discount, and in a period of time. And the second way is users can participate in this bonding process by joining Aladdin votes. And this votes will be votes recommended and voted through by the Boule Council. So the yields coming out of these votes will automatically 100% go to the bonding process, and the users will get reward in return in Aladdin token, and they will get a bit more. And there's also a third way for users to get Aladdin token. Just this is more for risk neutral users who can just buy Aladdin token and stake it, right? So you think about it, right? So so this is more for retail users who don't need to know a lot about the sophisticated stuff about DeFi, but they can just participate in the growth and of this portfolio of assets in the treasury just by getting the token and stake it and enjoy the compounding growth out of it. So the implication from this model is Aladdin's capital going to be long-term and organic. I think this will be super useful and meaningful for the protocols we work with, right? The protocols recommended and vetted by the Boule Council. So Aladdin is like this long-term capital, long-only diamond hand holder in DeFi space. The second implication is basically all the community members participate in the process, right? Can just work along with the Boule Council. So we run this like a open source fund, right? So people get to see everything we do at the back end, how we analyze projects, how we search projects, how we analyze projects, and how the Boule Council challenge each other and get to go through the vetting process and just select the best of the best in the DeFi space. And yeah, so just very high level recap of what we're trying to do for the new model. We would like to use these opportunities just to get feedback and thoughts from the big brains and see how we can improve it from here.
Yeah, thank you. So what do you think? Are there any questions or ideas?
Yeah, I reviewed the new token economics overhaul, and I was super impressed. I think it's a fantastic idea. And I think that as we start implementing these pools on the website, it'll probably allow for it. And once we start deploying capital as well, I think we'll start making a lot more noise. And I think that also once we start implementing these pools, there'll be a lot of co-promotion opportunities for the projects that we've started to work with, which will be probably one of the biggest sources of growth for Aladdin as well. If we can be seen as a blue chip TVL supplier for these protocols, then I think that everyone will be excited about it.
Yeah, thanks. Yeah, I also think we did see that we did see a range of different projects which we couldn't integrate with the old project, basically out of technology reasons, or because it's we were for all positions, and we did see different ranges. It's pretty complex products out there who not that simple to integrate, and I guess that's what I see with this model. We can also easily integrate them. Basically, we don't have to these technical obstacles to remove, because we can just allocate money to this project.
Yeah, very excited for all this stuff to come forward. I think if we just do a snapshot vote, I think there will probably be unanimous support for it.
And a vote about this? Yeah, the thing is, we have plans to vote it for Aladdin token holders. We vote the broader community. I guess it's important from government's perspective that existing holders who still stay with and hold the token, that they have like a say. And my take is we will have a yes. I don't think there's any, there's a lot of resistance basically, but I think it's important that, government's also a part to be public, to make processes public and show how you're changing. And we have like the Boule Plus members, and they are for sure, they want to see this to be executed. And I think it's a good point also to communicate who we are and what our plan is in the future, because if people vote, most of them read the text before they vote. And otherwise, if you just distribute information, then but maybe we should also vote for the Boule members, because I think we have different stakeholders. Of course, the Boule, but end users, and the Boule is somehow people on Boule, they hold also Aladdin token, and so we have like overlapping stakeholders. And I guess it's important to see, if there's some resistance, that there's a reason behind that, and then we will either sort it out or have discussion why we think it's the best solution right now. Maybe other ideas. It's just my point. I'm that's also why we do this in stages. That's one reason we ask now the Boule first, and we look what's coming back, and then we go more public and see what's coming back. And for myself, sometimes it's hard to see, the end user perspective, because I'm not typical end user. And this is one of the things we need too. So I know if you think about, you have this kind of product, would people invest? Would yourself, be a part of this? So any other feedback or ideas? We're more looking for, I think, negative feedback maybe, because we have been talking that it's not that Kruger didn't do it itself. We have been a lot of talks in the background, how we should evolve, and came to this conclusion.
I think this new model also kind of like brings everyone who earns yield through Aladdin into a family, because they'd be rewarded in Aladdin tokens instead of the underlying yield. Because like, if you were just to give them the rewards, then they wouldn't have like a vested interest to joining the Aladdin community. But in a way, they kind of have like a stake within the project if they generate any meaningful yield from their commitment. So overall, like, I mean, I don't really see any downsides to this new proposal. Also, it makes the token price correlate with the TVL, which is super interesting. Maybe if we had some sort of strategy to provide tokens to any of the protocols that we choose to party with, like Aladdin tokens themselves, to partner with, then maybe that token would have like a higher vested interest in cross promotions and things. But I think if we hit the nail on the head with cross promotion, and I think with the new token economics, we definitely hit the nail on the head with getting people to have a vested interest in the success of the community. And I think the marriage of those two would probably be like more than enough for like the success of this project.
Okay.
One idea that we did have that sort of speaks to that idea is just having a policy of, let's say we go long Maple Finance, that we sort of designate a portion of our holdings of MPL as like, again, the sort of like diamond hand LP position for their native token, which would be kind of like a, just an easy way to be like a sort of partner to them.
Yeah, I like the diamond hand strats, like overall, because the projects would really appreciate that. I think there'd be some things that need to be considered, like if we're just contributing capital to pool delegate pools, then we might have to like flip flop that capital into other pools at the maturity of different pools if they don't have like a rolling exposure option. But overall, like I do agree that like a long-term marriage would be a lot more fruitful for both ends.
Yeah, I just mean like providing like on like a common pair, like say on Uniswap or SushiSwap, just saying as part of our investment in MPL, we're also just going to supply 1/8 of our position in MPL is going to be in providing liquidity to like the mainly traded pair for that token, just as sort of like a thank you.
Yeah, I like that.
Yeah, I think if you have execute this and it starts to show up and it will be usable, then I think for sure it's a good strategy to reach out to protocols, because what I see, that's like maybe the benefit from who we are or what Aladdin is, that we already have people on the Boule who are well connected, and what you see with the like this the DeFi2 space now is sometimes very community driven, and this has like it's a strong narrative, and you have like instant customers for the thing you do, but sometimes we see like a lot of forks of different projects, and it's like endless forking and fork of forks, and somehow this also weakens the original product. And maybe not, it doesn't weaken the original product, but somehow I guess we have a much more position with this product. And I personally think it's good to move a little bit, to move out of the middle and to have something who is different. And I think the difference is that we take like if you yield farm with us, we take the whole fee which you give us, and this is like this is different. And I think it's important to have a different story to tell to be seen different, basically. And I guess one of the strategy behind this is also that if you can only hold the Aladdin token to take part in this, then we also can target retail easier, because then we can move maybe some of the liquidity to weaker and faster chains, and people can just buy there, and then it then just can be part of this without even touching mainnet, basically, and the rest is then done by us.
Yeah, it also frees us up a ton sort of on the back end, like a number of the strategies that people are bringing would be just sort of prohibitively complex to implement actually as a smart contract. Like I'm thinking of the spell MIM strategies from last week, where just sort of like actually, defining the logic for that being an open vault strategy, it's sort of like its own product. But now we're kind of, if we go with this model, we're kind of free on the back end to just, have one of our people sort of be a strategist around that and just implement that strategy.
Yes. Some other feedback or ideas? Yeah, but I see that we are in a way we will have also less like reputation problems, maybe, because if you assume that we have different projects, maybe the same API, but they have a different risk. They have a different risk profile, this project, even if they have the same API. And we see that, but retail sometimes doesn't see that. And this also means that we can, the background, much more think about how much risk we take with different protocols, or we integrate, because then we can also allocate capital to these different protocols, and also think more about the risk we take, because otherwise if people do it themselves, they don't have either you have to educate them very well on the risk they take on the different pools, or if you get bitten, then you have some kind of brand damage. And of course, if we lose some money because of project fails or so, then we will have some form of brand damage too, or a little one. But it's not that that some of the user base then takes a loss and others don't. I did see several of these events happening, and then sometimes, last week again, it's like the curve USDM incident, and then you have people that you have been in this pool, and then they take heavy loss, and others are fine, and you lose this these customers basically then. So I guess anyone else, you can go to the forum and give your feedback, or you can write us, or if you see something in this and if you see any risk, or I think mainly this would also be important to see. Yeah, maybe the.
We've also split up Boule members amongst Charlene, Martin, and I. So you should have gotten a DM from one of us. So if you have anything that you want to just talk one-on-one, or you don't feel comfortable sharing in the group setting, feel free to reach out to any of us, or specifically the person who messaged you, and just, yeah, feel free to give feedback in that channel as well.
Yeah, so I think I'm going to close this call. Thank you for joining, and also for this feedback and listening to the tokenomics overall. And we will work on this and execution. We don't know exact timeline how fast we can execute, but for myself, I think we are quite fast in executing this. The team's already working in the background, even if we don't have the vote, but I don't think there's an issue. And we will collect more information about this. The plan has been to do a vote and start it like in 6 days, maybe, if we are ready. It depends on the feedback. If the feedback is overall good, then we will go into a vote, and we will just vote with all-in token, basically, because these are the main token holders we have. And yeah, and then we also, this is more for background, we are also working on a marketing strategy, and also like a meme narrative to bring this to the people more, that as soon as we have integrated this and we are going public, that we will have retail users to join and see the value we create.
Hey, Martin, when is that other weekly meeting that's been happening? Is the Boule Plus meeting on Wednesdays?
Yeah, it's on Wednesdays. It's like a contributor call, we call it. So we discussed about yesterday. You see the link I shared. There's like an audio version of this. And yeah, it's somehow we have been thinking how we should change this call or rename it, and but at the moment we just stick with this. So it's mostly all the contributors join, and sometimes also Boule members are very welcome to join, and sometimes also it's open. It's on Discord. People from Discord too, Boule Plus member join too sometimes, and then we discuss what stage we are, and it's a public discussion basically. And we call it core contributors call, but somehow it's also like, it's not very, it's just more like a internal call where we discuss things, and it's less like a community call, but it's like an open call, everyone can join. And then maybe we'll change this in a more community-oriented call if the new product is out, but right now it's okay to have it like this, I guess. And it's one day, it's a day earlier than this call at the same hour on Discord. So if you want to join, you're welcome, everyone. Okay, so thank you for joining, and have a nice day. See you around.
Thanks, Martin. Thanks,
Yes,
everyone.
thank you.
Thanks,
Thanks,
guys.
Brian, Charlene, and Tom.
Yeah, bye.
Thank you, everyone. Thank you.